Everyone's been asking the same question. Why did the market suddenly collapse? Was it just another cycle? Was it macro? Or was there something deeper, something hiding in plain sight? Because what if I told you, the crash didn't actually start with Bitcoin. It started somewhere else. And according to a recent report, the entire cascade may have been triggered by a single token. A token tied directly to political power in the United States. Now if that sounds extreme, good. Because that's exactly what we're about to unpack. What happened, why it mattered, and more importantly, how you could have seen it coming. Welcome to Web3 Verse. The setup. This wasn't a normal crash. Let's rewind to October 10th. Because this wasn't your typical market pullback. There was no slow bleed. No gradual loss of momentum. The market didn't roll over. It snapped. Billions were wiped out in a matter of minutes through a brutal liquidation cascade. Positions vanished. Charts went vertical, downwards. And traders were left asking the same thing. What just happened? But here's what makes this event different. There were warning signs. Clear ones. And they showed up hours before Bitcoin even moved. The token at the center of it all. At the center of this entire situation is a relatively obscure token, WLFI. This isn't just another random altcoin. It's the governance token of a DeFi protocol tied to politically connected entities, linked to networks around former US leadership circles. Now on the surface that might sound like just another narrative play. But structurally, it's very different. Because a large percentage of WLFI's supply is held by a small group of insiders. Political affiliates, high-level advisors, early investors with privileged access. And that creates a very specific kind of market dynamic. Because in financial markets, information asymmetry is everything. The people closest to information move first, and everyone else reacts later. The first red flag, a leverage time bomb. Before the crash even began, WLFI was already flashing warning signs. The biggest one? Its funding rate. Now if you're not familiar, funding rates are what traders pay to hold leveraged positions in perpetual futures markets. When funding rates spike, it means traders are aggressively betting in one direction. In WLFI's case, those rates were extreme. Nearly 3 times higher than Bitcoin, equivalent to over 100% annualized cost. Let that sink in. Traders were paying absurd premiums just to stay long. That's not bullish. That's crowded leverage. And crowded leverage is dangerous. Because when everyone is leaning in the same direction, it only takes a small push to knock the entire system over. The trigger event. Then came the catalyst. A major geopolitical announcement dropped. Tariffs, rising tensions, macro uncertainty. And within minutes, something abnormal happened. WLFI's trading volume didn't just increase. It exploded. Over 20 times higher in a single hour. Not gradually. Not organically. Instantly. Now think about that. Retail doesn't move like that. Retail reacts slowly. This kind of move? That's size. That's speed. That's intent. Large players were exiting positions fast. The 5-hour window that changes everything. Now here's where this story becomes hard to ignore. After that spike in volume, WLFI started dropping. Aggressively. But Bitcoin? Bitcoin didn't move. For over 5 hours, BTC remained relatively stable. No panic. No major breakdown. Just sideways action. Which creates a very uncomfortable implication. WLFI moved first. It reacted to stress before the broader market even recognized it. Almost like a pressure valve releasing early. Or more accurately, a canary in the coal mine. Why WLFI broke before everything else? So why did this happen? Why WLFI? Comes down to structure. 3 key weaknesses. 1. Thin liquidity. There simply weren't enough buyers. When large holders started selling, there was no depth to absorb the pressure. Price had no support. 2. Excessive leverage. Too many traders were overexposed. And when price moves against leveraged positions, liquidations begin. 3. Concentrated ownership. A small group controlled a large portion of supply, which means coordinated, or even simultaneous, selling has outsized impact. Put all 3 together, and you don't just get volatility, you get fragility. The domino effect, how one token spreads risk. Now here's where things escalate. Crypto markets aren't isolated. They're deeply interconnected through leverage systems. Many traders use cross-collateral. That means multiple assets back their positions. So when WLFI dropped sharply, portfolio values declined, margin requirements were breached, liquidations were triggered, and to cover those liquidations, Traders had to sell other assets, including Bitcoin. The cascade begins. Once that process starts, it becomes self-reinforcing. Prices fall, liquidations trigger more selling, follows, confidence collapses. And then comes the critical piece. Liquidity disappears. During this event, order book depth across the market dropped by over 90%. That means even small trades started moving prices aggressively. And when liquidity vanishes, markets don't behave rationally. They accelerate. Why smaller tokens always break first? This event reinforces something important. Smaller assets don't just follow the market. They lead it during stress. Because they have less liquidity, higher leverage, more speculative participation. They act like early warning systems. WLFI didn't directly crash Bitcoin, but it triggered the chain reaction that eventually reached it. The political layer, the part people avoid talking about. Now we get to the uncomfortable part. This wasn't just any token. It was politically connected. Which raises questions most people don't want to ask. Did insiders have faster access to information? Were positions adjusted before the announcement? Did multiple large holders act at the same time? We don't have definitive proof, but we do have timing. And in markets, timing tells a story. What this means going forward. There are a few key lessons here, and they matter. 1. The market doesn't break at the top. It breaks at the edges. The most fragile assets crack first. That's where stress shows up. If you're only watching Bitcoin, you're already late. 2. Leverage is the hidden driver. Not headlines. Not narratives. Leverage. That's what turns small moves into systemic events. 3. Liquidity is conditional. It exists when you don't need it, and disappears when you do. That's the reality of modern markets. 4. Structured story. It's not about what a token claims to do. It's about who holds it, how it trades, and how it's positioned. So, was this the cause? Let's be precise. Did WLFI single-handedly crash the market? No. But did it act as the first domino? Very likely. It exposed weakness early, and once that weakness spread, the outcome became inevitable. Final thought. Crypto is changing. This isn't the same market it was in 2021. It's more complex, more interconnected, more influenced by power structures. And that means one thing. The biggest moves won't always start where you expect. The real question is, next time this happens, will you recognize it early? So I'll leave you with this. Was this just coincidence? Or was it a signal hiding in plain sight? Let me know what you think. And if you want to understand what could trigger the next major move in crypto, check out the next video. This is Web3 Verse, and I'll see you in the next one.